I'll just kind of give a rundown of what I talked about this week. Obviously, it was a pretty interesting week with the release of August CPI data on Tuesday, and from there it was pretty relatively brutal week across the traditional financial markets. So in case you missed it, obviously August CPI headline number came in at 8.3% year over year growth, which was down from July. July was 8.5% if you don't remember. But that consensus analyst estimate for August was 8.1%. So obviously a little bit hotter than expected. So not too much of a surprise, to see the reaction that the markets have had this week. And I think it's important to understand that even though CPI year over year was down in August compared to July, the markets are forward looking, and I talk about this all the time. But the markets are looking ahead, which means that they're operating based on expectations. So that aggregated expectation, among analysts on Wall Street was that CPI would decline by 40 basis points in August. It only fell by 20 basis points, so coming in a little bit hotter than expected. So we're seeing that sell off, showing that CPI didn't come down as much as the market was expecting. Furthermore, we can look at core CPI, which is CPI minus those two most volatile pieces, which is energy and food. And core CPI rose 6.3% year over year in August, which was the first month of an increase in core CPI since March. So that also is kind of adding to that, fuel of sell pressure that we're seeing this week. In the newsletter, I also break down. I made this little Excel table that shows all the different categories of the CPI market basket, so you can see exactly what is driving higher CPI values, or just elevated CPI values in general. It shouldn't be too much of a surprise that it's energy costs. The energy piece of that basket was up about 24% or so in the month of August. The two biggest pieces of that are oil, which was up roughly 69%, and natural gas, which was up about 33%. So those are some of those big drivers, and obviously energy is an input to the production of all goods, or the providing of pretty much any service. So when you see higher energy costs, you're going to see higher prices across the board, generally speaking. We also had PPI released on Tuesday, which is the producer price index, which is looking at the costs to producers, to produce goods. And it saw its second straight month of declines. So it was 11.3% in June, and then 9.8% in July. And then it was now 8.7% in August, which was actually below the consensus analyst estimate, which is a good sign. So, producer, or I should say PPI, is a leading indicator of CPI. And that when you have, like, for example, if you have a rising PPI, but CPI isn't rising yet, you're seeing higher costs to producers, which will eventually roll over to the consumer. So they're going to eventually raise the price for their finished goods in order to retain profit margins. So PPI tends to lead CPI a bit. So when we're seeing PPI declining for the last 2 months, that could be a signal that CPI is going to follow suit in the near future. Obviously, I don't know. Who knows? Anything could happen, but it's definitely somewhat encouraging to see. But I think what's most important to keep in mind is that the Fed Open Market Committee, FOMC, meets next week on Wednesday to decide what to do with the market interest rate, the Fed funds rate. So with that hotter than expected CPI, it kind of gives them a little more incentive to be a little bit more aggressive with the rate increases. So if we look at Fed funds futures data, which CME Group, and I include this a lot in the newsletter, so CME Group has a Fed Watch tool. It's free on their website, and it predicts based on futures data, what is the probability of seeing different sized rate increases. So currently, they're giving about a 78% chance of seeing a 75 basis point hike, and they're allocating a roughly 22% chance to a 100 basis point or 1% hike. And I think that's significant, because at this time last week there was a 0% chance, or they allocated a 0% chance of seeing a 1% hike. And you have this still elevated CPI. You have Treasury yields spiking, and I'm going to talk about that in a little bit. We go into that in the newsletter. So it's kind of, I think the market is signaling to the Fed that they have room to hike rates, and to continue to be aggressive and to keep them elevated for a period of time. Um, so, also from there, I kind of touched on a couple, key news stories this week. There was, the railroad strike that the Biden administration seems to have avoided with a deal yesterday. And I talked a little bit about, what would have the, results been on the economy if the railroad workers did go on strike. 28% of U.S. freight movement is on trains, so that would be a stressor, a inflationary pressure on the price of goods. And I also touched on that the Biden administration is weighing buying oil at $80 a barrel to refill the strategic petroleum reserve. So, just a couple things there that I found interesting and relevant towards the economy and current economic conditions. Um, and then I also touched a little bit on Wall Street, and I feel like some of these firms are definitely starting to feel these recessionary pressures. So Monday was the announcement with Goldman Sachs announcing a planned layoff of hundreds of employees, and that kind of falls in line with this 50% decline in reported revenues across divisions that they saw in the second quarter. They saw a 41% decline in revenue from their investment banking division in July, which is in line with JPMC's 50% decline in IBD revenue in Q3. I just thought it was interesting and worth noting. But what we're seeing is that initial jobless claims, which is a measure of unemployment, is declining. So there's kind of this weird disconnect where if we're looking at the economy and the job market in aggregate, like with initial jobless claims, we're seeing unemployment is falling. But it seems like every week it's a new company announcing layoffs, or multiple companies announcing layoffs. So I just thought it was interesting and worth noting. Um, I feel like one of the more significant, other than CPI, of course, news stories this week was mortgage rates cracking above 6% for the first time since 2008, and that kind of comes alongside this CNBC article that I thought was interesting and threw in the newsletter. That shows that year-over-year demand for mortgages is down 29% as of this week. And I talked about this last week in the newsletter, but it's this decline in mortgage signings, which is forcing banks to raise interest rates. And obviously, you have the market interest rate, the Fed funds rate that's rising, but it's kind of adding fuel. And you can see why mortgage rates are spiking so hard or so high, is because you have that rising Fed funds rate, but you also have this declining demand for loans. So in order to make up that lost revenue, the banks have to raise interest rates on those consumer loans like mortgages. So, moving on to the stock market, and I won't go terribly in depth here, but the major indexes are obviously having a rough week. We're down 1.5% today on the Nasdaq. So and it's kind of what we talked about in the news. If you've been paying attention to the newsletter, it shouldn't be too much of a shock what's going on here. And it's we were due for an oversold bounce, and we were due for a short covering rally, which is exactly what we saw last week. And then that kind of ran into resistance around the 20-day SMA, and then we reversed lower. And on Tuesday, it was the worst single day performance for the Nasdaq in this bear market, and the worst since 2020. So it's kind of that short covering rally that is quickly stuffed. It's quick, it's aggressive, and it's exactly what we talked about in this newsletter for the last couple of weeks. I think despite the weakness in the major indexes, there's a ton of growth stocks that are acting well, that are showing tons of relative strength. And I think that's important to pay attention to as an investor, as a trader. So I just, for the benefit of people who are investing and trading, I just threw in some of the stocks that I think are leading at the moment. I'm obviously not endorsing that you go out and buy them, but I just thought it was, worth noting. So if you're interested in that, be sure to check out the newsletter. And then, as I alluded to a little bit ago, we're seeing this intensifying sell-off in the fixed income market. So that's yields are spiking, right? So yields and bond prices have this inverse relationship. So when we see yields spiking, it's a sell. It's signaling this intense sell-off in the bond market. So at the time when I wrote this, 2-year yields sat at 3.92%. Currently, they're at about 3.9%, but they're up roughly 35 basis points from last week, which is pretty significant, I would say. And that brings that 2 to 10 year spread, which I talked about last week, back down to roughly negative 0.44. And that year to date low is at negative 0.48. So it's kind of showing us that, it's just showing us the effects of a hotter than expected CPI number. And it's showing us that investors are, increasingly concerned about near term economic conditions. And that's something that the Fed is taking into mind. And furthermore, on Tuesday, which is kind of fueling this sell-off in the fixed income market, is the U.S. dollar currency index, which is known as the Dixie. On Tuesday, had its largest single-day increase since March of 2020. So it's kind of this combination of spiking yields and spiking Dixie, which is placing this macro pressure on equities. So I think it's pretty fair to say that we're out of the woods. And since Bitcoin is a risk asset, which I discuss a little further down in the Bitcoin technical analysis section, they kind of have this very similar relationship, right? The Nasdaq and the S&P and Bitcoin. So this pressure from yields and the Dixie are placing pressure not only on equities but also on Bitcoin. So that's kind of what we've seen from crypto plus equities this week as well, is that they're sort of breaking down, not to the degree that Bitcoin is, which I think is pretty interesting because you're seeing the Nasdaq break down, you're seeing Bitcoin break down, but a lot of these crypto equities have actually just gone sideways this week. And I didn't really feel like there was a ton to talk about from that industry group. I talked a little bit about SI this week, but other than that, I didn't provide a ton of insight there. I provided that Excel sheet that I always do, and then I talked about Bitcoin TA, like I just talked about. Looks pretty weak, but yeah, that's pretty good summary of what I talked about. Sorry, I kind of rambled on there.
No, that was great, but that was a lot of good information. Is there any chance of a soft landing, or is that just sort of like an imaginary fantasy land?
I think I mean it's theoretically possible. I was talking about this with a friend the other day who was asked like the exact same question. And it's kind of it's theoretically possible. I don't think it's necessarily like fantasy land. I think they could do it. I think it's extremely difficult to do it, especially when you have this much debt in the system. So you need to raise interest rates and you need to keep them elevated for a period of time, but it's kind of this balancing act of keeping interest rates elevated to the point that prices start to decline, but you don't want to kind of crack that bubble of insolvency, and you don't want to crack that bubble of employment. So there's kind of a really thin line there that obviously there's people that are a lot smarter than me that are paying attention to that work for the Fed and that are deciding where's that threshold of how high can we bring rates and how long can we keep them there. I think it's theoretically possible. I think it's extremely difficult to do. I feel like it's unlikely, but I'm not necessarily saying that I think we're due for a 2008 recession, 1933 Great Depression. But I think it's definitely difficult to do, and the Fed talks a lot about the soft landing, but I think they kind of overestimate or underestimate how difficult that is to do.
Yeah, that's a good point. It's interesting to see right now the Fed funds rate is about where it was in 2018, where they decided to pivot back. Except this time around, the debt's so much higher and the CPI is so much higher. And it's just important to remember, we got 8.3% CPI this August. That's on top of 5% last year, and 2% used to be ideal. So when we all know about compound interest. So when you stack an 8% price increase on a 5% price increase, like it's just getting bad. And when you talk about the railroads, that sort of brought this idea to me. Like railroads are supposed to be like the safest stock, right? Like that's never a problem. But it just goes to show that any equity is a risk asset. And when you exist in a world with fiat currency where that's guaranteed to lose value, and you have to hide in equities, you have to hide in real estate, you have to hide in gold, perhaps. There's nowhere safe to just save, and that's why Bitcoin is so important. Even though in the short term right now it is behaving as a risk asset, that's just a function of a misunderstanding on aggregate of what Bitcoin is and the solution it provides. So I don't know, when you talk about railroads like that brought that to mind.
Yeah, for sure. I mean, it's just that idea of counterparty risk. The fact that you have to trust another company or another person to have the investor's best interest at heart, and which is sort of the reason why you see equities as risk assets and the degree of volatility that we have. You also have a fair amount of political risk with a lot of equities. You have market risk, volatility risk, and I think the political risk with Bitcoin is probably one of the main reasons, maybe the main reason why you classify it as a risk asset. Obviously, the volatility is a piece of it, and financial institutions are relatively short term, and that you don't want to put away $1 billion into something that could be down 70% in 9 months. But I think the political risk is the biggest piece, right? You don't know what the future tax reporting standards are going to be for Bitcoin, and you don't know, are they going to ban proof of work? Are they going to ban Bitcoin? Is the government going to, or is the Fed going to create a digital currency that is going to make Bitcoin obsolete? Who knows? And I think that's kind of that reason why it would be classified as a risk asset.
Yeah. Before we go to on-chain real quick, I wanted to touch back on the idea of the soft landing that you guys mentioned. I know we talked about this in previous Twitter spaces, and it's interesting. I think like a few weeks ago, didn't think it was like a high probability, but I was more hopeful than I am now of the idea of a quote unquote, infamous soft landing. I think, with the CPI measure that came in this week and the graphic that you guys put in the newsletter where core CPIs, was declining basically since March of this year. And now it increased in August. Do you think that, it's increasingly unlikely that we'll see a soft landing, or is the odds maybe still the same?
That's a good question. I feel like probably decreases the chance of seeing a soft landing, in the fact that you need to, bring the Fed funds rate higher than you maybe would have if you had that, if CPI came in at that, market estimate, and with having to bring interest rates higher and keep them there for longer, you're increasing the probability that you create a hard landing. But kind of like what you alluded to and what I said earlier, it's theoretically possible, but in reality, it's much more difficult to do than the Fed likes to say. Obviously, they're trying to inject a little bit of confidence into the market. Obviously, Powell's not gonna come out and say, "Yeah, no, this is really really hard to do, nearly impossible, but we're trying our best." Obviously, they're gonna say, this is what we're doing. We're going to have a soft landing, and they're trying to inject a little bit of stability into the markets. But yeah, I would say the probability is less when we see CPI coming in hotter than expected, like it has been.
We can shift gears now to the on chain. Let me post my thread to the Nest real quick. Boom. So I like the on chain because when we talk about the macro, it gets a little intimidating. Nobody knows what's going to happen in the short term, and everything could tank. But on chain allows us to zoom out and see where we are in the greater Bitcoin cycle. So first up is the long term holder and short term holder realized price. Like they're getting so close to crossing, and when they do, that's the ultimate sign that like we're near the bottom of the bear market. Who knows how long the bottom could last, but every time these metrics cross, it's a great time to buy. When you look at the zoomed out version of that chart, I believe it's second in the thread. If you notice, there's sort of a staggered way. So the short-term holder realized price will increase, and then a few months down the road, the long-term holder price increases. And what I'm seeing here is these are short-term holders aging into long-term holders. So right, like a lot of long-term holders, a big percentage of their bags are from the early days of Bitcoin. 2010, 2011. They have really, really low on-chain cost basis if they haven't moved those coins. So buying it here at 20,000, even if they buy a good amount, it's not really going to move the needle on their cost basis. So in aggregate, the only way that the long-term holder realized price can go up these large amounts is short-term holders becoming long-term holders in large quantities, right? With their, they bought the top or whatever, they bought in 2013 at the top in the hype, or 2017 in the hype, but then they stick around, right? They stick around with that higher cost basis and they become long-term holders, and that drives long-term holder cost basis up. And you can see that too when you look at the net position change. So you see huge spikes in the short-term holder net position change at the top of the bull market, and then about 6 months, 155 days roughly after, you see a huge decrease in the short-term holder net position change, but a nearly identical increase in the long-term holder net position change. So this is these short-term guys, realizing what Bitcoin is, what it provides, more the number go up, and they're becoming long-term holders. So just every 4 years, you're going to get these new cohorts of Bitcoiners that are here to bid for the 21 million, and they have no intention of selling. So, that people like to say that 4-year cycle might not exist in the future, but I think as long as the halvings keep happening like they've been, you're gonna have number go up, and every time you have number go up, you're gonna have people who, a certain percentage of them aren't gonna stick around. They're just gonna want to make quick bucks, but a certain percentage are gonna stick around and learn more about how Bitcoin works technically, and its implications on economics and society, and those are gonna be your new long-term holders. When you look at the growth rate for entities right now, so what this is there's a Glassnode metric called net entities growth. So it just takes a difference between new entities and entities that are leaving the network. And when you take the cumulative sum of that, you can get the total entities on the network. This is what we did for our Bitcoin user adoption report they released a few months ago. Make sure to go check that out if you haven't already. But when we're looking at this and we look at the growth rate of total entities, it's way up over the last year. So in 2017, there was a huge spike in new users, but it wasn't sustained. That growth was not sustained. This time around, that growth is sustained. Even since spring of 2021, when we had the mania, crypto season, whatever, the whole world was like watching Bitcoin. Elon Musk is going on Saturday Night Live talking about Dogecoin. Like, well, that's not Bitcoin. It does bring attention to Bitcoin because everyone knows that Bitcoin is the king. So ever since then, the growth rate has not slowed down in new users. Prices went down and then it went back up and now it's back down, but the growth rate has stayed high. People are still going and making new wallets, and new people are joining the network and bidding for these coins. And these people aren't sitting around either. They didn't just make wallets and they're not using them, because you can look at the supply held by entities with 0.01 to 1 whole BTC, so 1 million sats to 100 million sats. They've been stacking. We showed this chart a couple of weeks ago, but it's always good to take a look at it. When you look at the change in supply held by these entities, the 90-day change is still way up, higher than it was in the 2017 bull mania. So and this is since we've dropped to the 20K range. Like we have been stacking, like the smaller entities that are newer to the market have been stacking tremendously during this bear market, and that's great to see. That's really bullish for Bitcoin in the long run. And then we got a couple of the valuation metrics we look at pretty much every week: MVRVZ score, flow multiple, Mayer multiple. They're all screaming right now. You need to be dollar cost averaging. So if you have a long-term time horizon, this is a great time to be buying in size. We are correlated to equities in the short term, so anything could happen in the short term. Don't put next month's rent into Bitcoin, but any long-term savings, it's a great spot to park that. And then the ETH merge happened this week, but that was a seems to be a classic buy the news, sell the rumor type of event. ETH bounced off the 0.08 BTC marker. If you're really if you're into Bitcoin like that, you got to price everything in Bitcoin, including Ethereum, and it has not been able to come close to its all-time high from 2017. It can't break through this 0.08 resistance. If the merge doesn't do it, I don't know what will. So just that's something we're going to keep an eye on. I'm not sure if it's going to be able to break that level ever. So it didn't this week. We'll keep an eye on that. Joe, Blake, you guys got any comments?
I think that was fantastic coverage of the on-chain section. I'm curious to get your thoughts going back to the Bitcoin total entities growth rate. It is interesting how you pointed out how so many entities were I guess buying Bitcoin and holding their own keys at near the top of 2017, but once the bear market ensued, the growth rate plummeted. But as you mentioned, this we did see a huge growth rate obviously in early 2021, but growth rate really hasn't plummeted, and especially into the bear market, we kind of saw a spike almost to the same level of growth rate that we saw in early 2021. Do you think institutions, or quote unquote institutions like Celsius and Voyager, these Bitcoin quote unquote yield platforms, played a role and maybe waking people up that it's important to take self custody?
Oh, for sure, definitely. Like, I knew people who they understood Bitcoin, and they understood, they understood the mantra, not your keys, not your coins, but they were still kind of greedy and took the risk for a little bit of extra yield. But this was definitely a wake up call. No exchange is safe. You have to hold your own keys. I see Trey down there from Unchained Capital. He knows all about that. Not your keys, not your coins. The Celsius BlockFi stuff definitely woke a lot of people up to that. I think the Canadian trucker event did too. There was a lot of confusion in the normie world about, they froze Bitcoin on people's Bitcoin, but that was on an exchange. Exchanges are at the root, they're not really any different than a bank. Except a bank, they are FDIC insured. They do have to pay you back your deposit. A crypto exchange has no obligation to do that. When you look at their terms of service, when you sign up, you're basically forfeiting over your money and you're getting an IOU. So unless you withdraw that Bitcoin from the exchange, you are not truly taking advantage of the peer-to-peer network.
Yeah, to me, it's also interesting because in 2017, we saw the spike in the, on-chain entities growth. I feel like that was, mainly new entities, right? And same with 2021. But I'm wondering if the growth rate that we have seen during this bear market of new entities isn't necessarily like quote unquote new Bitcoin holders. It's just existing Bitcoin holders that may not have fully understood Bitcoin, but due to the issues that those platforms have had, they've kind of woken up and realized like, hey, I need to hold my own keys. So maybe they're not necessarily like new Bitcoiners, quote unquote, but they're more knowledgeable Bitcoiners.
Yeah, I think that's a good point. I think you're probably spot on there. And at least to me, when I sort of do classify that as a new Bitcoiner, right? Like, unless if you have your Bitcoin on the exchange, not to sound rude, but I don't think you truly understand what it is. And you might, if you have it on the exchange too, you're also obviously more likely to sell it because, it's only 2 button clicks away. Versus if you have it in cold storage, that is more of a process, and you don't put it into cold storage unless you're around for the long term. So I guess I think you're right, but that is a huge like sort of education point right there. Like people who may have been like halfway into Bitcoin, halfway there to understanding it. This whole event of the past few months with Celsius and BlockFi probably pushed a lot of people over the edge into to truly like understanding Bitcoin and what it is. With that, if you want to get cranking on the mining side, Joe, the floor is yours.
Absolutely. Give me one sec. But yeah. I'm going to be mainly talking about two things in the mining section of the newsletter that we put out this week. One was mining difficulty hitting an all-time high. I always like to say that there's actually two prices of Bitcoin. You have the dollar price of Bitcoin or any fiat price, and you have the kilowatt hour price per Bitcoin. The dollar price per Bitcoin, as we all know, is extremely volatile. It goes on massive parabolic bull runs, and it, follows with massive declines. But the kilowatt hour price per Bitcoin is, pretty much on a steady uptrend. There are periods of time when difficulty does contract, but it happens a lot less often than the price of Bitcoin falling. So the kilowatt hour price of Bitcoin did make a new all-time high. This basically means more miners, more hash rate is coming on the network, and I think can be attributed to three key reasons. The first one is mining rigs that capitulated this summer have at this point been sold. They've been relocated and they've been plugged in by more efficient miners, likely with lower energy costs. So much of the hash rate that came offline has now likely turned back on. Second reason is the new generation rigs that have been that were released basically this summer have and are continuing to be released. They're getting shipped and plugged in pretty much all over the world now. So this includes both S19XPs from Bitmain and M50s from MicroBT. I mean, these are the most energy efficient rigs on the market, and they're hashing at 140 terahash and 114 terahash respectively. So they're powerful machines, and it's a big reason why we've just seen mining difficulty hit a new all-time high. Third key reason is power curtailments. So as you guys saw in July of this year, Riot did that, interesting press release that basically showed they made more money not mining Bitcoin than they did mining Bitcoin. And the reason they did this, or the way they did this, was by enrolling in these very unique demand response programs where when the grid is strained, they can actually sell their energy back to the grid at a higher price than they would basically be earning by using that electricity and plugging and running their machines. So this was obviously a key example of how Bitcoin miners are making energy grids more resilient and more reliable. But the point of this was to show that the Texas grid and grids throughout the world are a little bit less stressed due to it's not summer anymore. There's not the extreme heat that everyone's running their AC at the same time. So miners in Texas and all throughout the U.S. have been able to not have to turn off their machines or weren't economically incentivized to turn off their machines. So I think that's another key reason that difficulty hit a new all-time high. The second major topic that I wanted to cover in the newsletter, this is someone deemed me about this actually metric. It's called basically the miner balance metric, Bitcoin balance metric on Glassnode. So Glassnode has a lot of great data and resources, but if you misinterpret what it's presenting, you can create really misleading narratives. And I've discussed this in a newsletter and in Twitter Spaces all throughout this summer. But Bitcoin miners were capitulating from May to August. Hash rate and mining difficulty were dropping. Public miners were selling more Bitcoin than they were mining, and the general market sentiment was risk off. But this miner balance wallet metric, it actually appears ironically to show the exact opposite. It shows that miner balances were actually increasing significantly during that time. And I think it's first it's critical to understand like the composition of this metric. Like, how are they creating it? First, a large majority of these coins in this Glassnode metric and other blockchain like data aggregators have similar metrics that actually show similar results of this metric, where quote unquote miners are increasing their wallet balances. But a large majority of the coins in these metrics are just early miners and Satoshi. So this is not really a good representation of active miner balances, as many people might just interpret it if they're looking at it very quickly. Second, I think tracking existing or active miner balances is nearly impossible, right? Hash rate, gets pointed to mining pools. Mining pools distribute Bitcoin periodically to miners, usually when a certain threshold of withdrawal is reached, and then miners then collect a majority of their rewards in their own cold storage wallet, not necessarily their pool's wallet. So this metric is mainly composed actually of early miners and pool wallets. So it's not really giving you a clear idea of whether miners are actually holding or selling. And very interestingly, the recent increase in this metric can mainly be attributed to the quote unquote other miners, which is basically old miners that were mining Bitcoin from 2009 to 2012. And it can also be attributed to the Poolin mining pool. And I don't know if listeners have seen, but Poolin has been quote unquote having liquidity issues. So it's kind of difficult to know exactly what is happening with their wallets, but apparently they're getting more Bitcoin in their wallets, but they don't actually, maybe they lost the keys to that Bitcoin or something. So it's just kind of interesting to see that some people will look at this metric and be like, oh, wait, miners haven't been capitulating, they've been stacking. But in reality, it kind of doesn't show that at all. And it's, in my opinion, a very misleading metric. And I don't want people to get confused to think that most miners are accumulating Bitcoin at a rapid pace. most miners are still selling, pretty much all of the Bitcoin they mine, at least the publicly traded ones. And they're in a very risk-off scenario trying to, survive the bear market and, trying to take it easy.
That was great, Joe. I think you bring up a really good point about Glassnode and on-chain data, because it is just a data science, right? And the data gets manipulated all the time. So this is no different. You can present any narrative you want, really. You can find data to support that. So I think Bitcoiners are just skeptical people in general. So that hasn't been too much of an issue. Bitcoiners tend to, at least people who are in Bitcoin right now, they're very aware of the information that they're intaking. But you got to be cognizant. Even Glassnode, you can use that to present a certain metric or a certain narrative. So definitely got to be cognizant of that. And do you think this pooling thing is going to be like the Mount Gox for a mining pool, or is that speculation?
No, I mean, it's a good question. I haven't dug too much into it. I've never met any of the guys at Poolin, but yeah, I mean, it's just another lesson. Like, not your keys, not your Bitcoin. I think most miners are generally smart. Like, they don't hold large wallet balances with their mining pool. They reach that, relatively small, like less than one Bitcoin threshold, and they have that Bitcoin, regularly sent to their own cold storage wallet. Public miners may have, more like an institution helping them do this, or an institution that helps them hold their keys, or maybe holds their keys for them. But generally, I don't think many miners just store their Bitcoin with the mining pool that they're mining with. And this is a wake up call. If you are mining and you haven't withdrawn your Bitcoin from your mining pool, it's probably a good idea to do so.
You got to think most people that are cognizant enough to start mining would also know to take their self-custody their Bitcoin. But you can never be too sure. A lot of people were on these yield platforms, so you never really know. um I guess this is a good place to wrap up, unless you guys have any other thoughts you want to share.
No, I don't have anything, Joe. I think that was great.
Thanks, Blake. Yeah, no, I mean, my only closing thought is, Bitcoin is a highly volatile asset. In the long run, we know that the dollar is designed to debase, but in the short term, we can go through extremely turbulent times. And I think it's important that, people keep their, stack of Bitcoin in cold storage, but they also have, other assets and other cash flow to get them through, and to basically enable them to be the buyers of last resort when times get tough, like they are now, and they could get tougher. But I think it's important to not be too exposed to certain assets, like Bitcoin, when if we do fall further and bad things happen, you now become a seller of first resort rather than a buyer of last resort. So I think it's critical that you position your personal portfolio in a way that enables you to capture any major downside, and it gives you the kind of the peace of mind that you can survive dark bear markets, because parabolic bull markets in Bitcoin, it'll come. It's just a matter of time. But if you're not positioned correctly to capture them, then you're not going to benefit.
Bear markets are all about survival. Can you survive? And that's the main question. I got one more thought I just want to throw out there, because there's been a lot of talk. The White House has been trying to talk about Bitcoin. That the whole merge thing. It's about like energy FUD, and just ignore that. China tried to ban proof of work mining, and it hasn't worked. So just that Bitcoin is, they can't stop it down. They can't shut it down, but they can resist for a long time. So just keep holding, keep buying. The network will survive, and eventually, we understand what this is. So times may be tough in the next year or two, but keep a long time horizon, low time preference, and it'll be all right.
Awesome. Thanks, Mitch, for hosting, and thanks everybody for joining.
See you guys.
Have a good weekend, everyone.